Good morning. This is Jim Colburn of Commodity Research Group. I'm here with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is September 10th. Andy, good morning.
Good morning, Jim.
We had a extremely quiet market in July and August, and then September came along and boom, prices went sharply lower. Why don't we start there, and why don't you tell us what happened?
Well, the market is soft, Jim. It's soft on a lot of fronts, and I think that let's talk about some of the fundamentals that have taken us out of that trading range that we were in for most of the summer. I thought if you looked at June, July, and into August when we were in this range, the market was by and large balanced, really. We were beginning to draw stocks, and the market I thought had reached an equilibrium at a low price level. I don't think anyone was particularly happy with the price level, at least on the producer side. The consumers probably happier. And then as we headed into September, well, what happened? Well, we received 2 million barrels a day more of crude from OPEC plus, and we probably didn't need those barrels, Jim. Interesting, Saudi is up 1.5 million barrels a day since June. OPEC plus has been trying to manage the market as best they can, and I think they were hoping that demand would be by this point stronger than it is, and Jim, we're just not seeing that big increase in demand, and as a result, this large stock draw that we thought would be happening by now, we're not seeing a big stock draw. Maybe we saw 1.5 million barrels a day during the summer, maybe a bit more than that. And as we head into, last month, a slight stock draw. Now in September, maybe we're seeing a modest stock draw, but it's just not enough. So as a result, the market has actually softened, I think, for good reasons.
So I'm looking at the October crude. We're around 37.80 right now. And if I were a technician, I'd say, well, we went up to that. We covered a gap that was made in March, where the OPEC meeting was collapsed, and over the weekend the market traded sharply lower. Why did we lose all that volume in July and August? Is just the market kind of following the stock draws? Like you said, it was in some kind of equilibrium.
Yeah, I think we were in equilibrium. We were drawing stocks, and it looked like, as I said, supply and demand had, maybe demand was a little bit stronger, and the market was able to hang in as long as it could, and it was as you and I would talk about, and I think everyone in the market was talking about, that it was extraordinarily quiet. We saw, where did the vols go, Jim, during that period? The volatilities.
Well, if you take the April minus $40 prices, where the Black-Scholes volatility blew up. I mean, people say it was over 300%, but it got down to 29.6 on September 1, and then with the sharp decline, it got out to 50% on September 8, and actually the volumes actually picked up. So July and August, we averaged about 65,000 WTI options a day, and we were probably 2 to 3 times that as an average, previous. So we're now trading over 100,000. There was a 200,000 day. So the market definitely picked up in activity as the vols blew out. And then on yesterday's rally, we came in to 45.5 on low volume. So yeah, the market's not totally asleep. It definitely woke up. We'll see what happens from now, whether we make new lows, which we will talk about. Why don't we start with OPEC, Andy? You said OPEC increased production in August.
Yeah, they've increased production from the June levels by 2 million barrels a day, and we've seen an increase in non-OPEC as well. Russia increased by 400,000 barrels a day. OPEC has looking at the cartel. They've actually done a pretty good job on complying where they're supposed to be. Iraq has cheated on its quotas, or should I say, what are they called now, Jim? Laggards?
Well, they're laggards for a while, and then I think even the press started calling Iraq cheaters. So
right,
yeah.
Right. But Iraq reduced production, and if you look at where they were supposed to be for August, basis their last meeting, they're pretty close to where they're supposed to be. They've gotten a huge benefit of Libya not coming back to the market and the continuing collapse of the Venezuelan oil industry. So they've increased production, but that was based on a forecast that demand for their crude has increased. And, the call does look as though to me, it's like 1.5 million barrels a day higher than their production. Maybe it's actually less than that. I'm not sure. These demand numbers are really tough to get right,
Yeah.
to say the least. But this is not what they wanted, clearly, from their managing of the market. They wanted it to go to the other direction. I think if they're druthers, they'd love to see Brent, into the 50s, low 50s. They got close. Now they're meeting September 17th, so next week, and there is a chance that they say, okay, that we may need to trim our production because demand is not coming to where we really thought it was going to be. They'll probably yell at Iraq a little bit and say you need to reduce production, but it's really going to be incumbent on the Saudis if they're going to trim their output in October and November. For September, they lowered their prices, and they lowered their prices because these margins are killing their clients. That's
right.
Refinery margins are brutal.
Right.
And so they did lower their prices for September, but maybe in October, they may have to trim.
It was some of that Saudi increase for burning oil during the summer.
Yeah.
They're still doing that.
They're still doing that. So they're trying to keep their exports at a certain level, but they've certainly stopped the deluge to the U.S. The other thing that's hurt them is that China stopped. China was loading the boat,
Right.
literally and figuratively, loading the boat. When it came earlier in the year, they got to the point where they just couldn't take anymore. And come August, that big bid that we saw from the Chinese was not there on the crude side.
Yeah, from my old days as a wheat analyst with the USDA, I just recall China being a very opportunistic buyer, where they'll just all of a sudden stop and wait for the prices to get to a better level and then come in again. So do you have a sense that that's what's going on here, or they just are choking on, they don't need it?
I think they don't need it right now. They may step in again. Maybe in September they need to run off some of this surplus. End user demand in China is pretty good, for refined products, and that's probably helpful. Sinochem said they thought Chinese demand in the second half of the year was going to be up 1% from a year ago. So there is some growth there, but that's, we're only talking 100,000 barrels a day from year ago. Certainly way up from earlier in the year. So at least China's showing some signs, at least for refined products, that there's demand there on the government stimulus.
Yeah, I mean, we've seen some of the numbers come out for their jet demand, which, compared to last year was better than most countries, but it's still not back to what it was last year, like the jet fuel. So, I'm not sure. I think I just saw the EIA revised global consumption in 2021 down 600,000 barrels, and the large bulk of that, I think almost 500,000 barrels was due to lower growth in China. So I don't know if that's based on a GDP number or the actual product demand numbers that they're seeing so far, but that's a significant reduction in demand.
Yeah, definitely. Maybe that, I would just have to guess they were too high on China to begin with, and as I just said, it's like impossible to get these demand numbers.
Well, I was going to say 2021 might as well be 2121 because it's so hard to forecast these things.
Right, but I think you mentioned there, one of the big problems in this market, and the major headwind is jet fuel.
Yeah,
it's just not recovering. And now the EIA, the EIA thinks that in third or fourth and first quarter, it's really going to grow. But I don't know. I don't see. I don't see how.
yeah, I don't. I mean, certainly discretionary travel by people like myself is going to be not recovering very quickly. I'll tell you that. That's like
Right. We're going to need.
anecdotal.
Yeah.
But
Well,
still,
you and I are going to need vaccines. I
we're
mean,
going
we
to need
may get
good vaccine.
good
Not
vaccines, right?
yeah.
Yeah, to resume our discretionary travel
Yeah.
and business travel too. I think it's probably going to be soft here in the fourth and first quarter. So jet, that continues to be, if you want like real growth in demand, we've got to get jet at least back to where it was, and we're millions of barrels a day below where we below pre-pandemic level, and it doesn't look like the U.S. is coming back strong at all. I think we're probably like 700,000 barrels a day below pre-pandemic levels on jet fuel.
Yeah, and that's significant. Speaking of jet fuel and distillates, and we had talked about the distillate stock levels being very high and kind of not moving. Like, I mean, gasoline at least was moving lower, crude oil was moving lower, but distillates were hanging up there, and you really didn't see it collapse until recently. The cracks have come
Right,
down.
right.
Why did it take so long? And is it where it should be now? What do you think about that?
Where the cracks should be?
Yeah, yeah. And
Yeah, I mean, they have been, if you look at the crack chart against Brent, say, it has been at a steady decline. It's really picked up. It's really picked up here on the downside in the last couple of weeks, probably because, I think the market's beginning to lose hope.
Yeah,
Because we're like nowhere here on diesel, on distillate stocks. Just look at this last week, Jim.
yeah,
We're at 175 million barrels, US this is, and that's 46 days supply. So that is, days supply is stocks divided by demand.
Right.
And the 5-year average is 144 million. So there's 31 million. And days supply is 36.
Yeah, off a much higher
We're
demand
10
number. Yeah.
days, yeah, we're 10 days over that. That's a huge amount.
Yeah.
And I really don't know, unless refiners can figure out a way to run crude and not make any distillate at all, how we're going to get, how we're going to get through, how we're going to draw these distillate stocks. I mean, we could use an Arctic winter, that'll help.
Yeah.
And we could use diesel demand, we could use the economy to really start, growing like like nobody's business.
Yeah, it's interesting. Also, in the EIA report came out yesterday. As I'll say it again, I think it's highly underrated as a monthly supply demand piece. But they have a chart in there showing like cooling degree days above normal and heating degree days above below normal. And over the last couple of years, you see that the cooling degree days are above, normal, and the heating degree days are below normal. So I always thought it would be you know, when we do our comparisons, do we have this warming up of the temperatures built into these models, and maybe we do, and maybe the thing we're not prepared for this winter would be a vicious cold snap, but I don't
Well, it
know.
certainly would help to get rid of this surplus, the manufacturing numbers. The other thing, talking about maybe why distillate was hanging in there, the manufacturing numbers were actually pretty good.
Yeah,
I think it was was it the July or the August isms? I mean, they both showed pretty
right.
good.
Coming
They
back.
were good. And manufacturing, of course, is a key to diesel demand, because as we manufacture more goods, they're trucked and railed all over the country. But we'll see if those demand for goods, continues. There may have been some pent up demand for goods, and maybe that's easing off. We'll see.
Yeah, it's if you look at this, I hate to keep leaning on this EIA report, but they have a piece in there showing the Goldman Sachs commodity indexes for energy and for non-energy, and then they put the S&P up there, and you see the S&P is up. The non-energy is down about 5% for the year, and the energy is down about 50% for the year. And
Wow.
it just tells you where the S&P is catching all that high tech money going into high tech because they're doing well. The non-oil commodities, think about things like lumber and copper and stuff like that. It's partly China, partly the housing's doing well. Maybe cars have come back a little, so there's that part of it, and then the transportation and part of the commodity indexes is not doing well, as we have mentioned, but it's definitely showing up.
Right. And I think, you and I usually aren't sort of poo-poo the risk asset story. And when the market gets hammered, the stock market anyway, it has a spillover effect. I think at this point,
Yeah,
certainly when the market was getting hammered last week, I think there was a spillover effect into commodities and into our commodity, into energy, because the fundamentals are not, they're not great.
right. Yeah, I mean I need to hear the story behind the price movement, specific to that commodity, and I don't like, the dollar does this, the dollar does that, therefore commodities do this. It just it, it it certainly correlates. I'm not sure it's always. There's usually like a third factor in there that is causing both to happen.
Right, and the weakness of the dollar weakness over the summer. What kind of effect did it have on oil prices? Nothing. I mean, we kept we were in a narrow range, and every day the
Right,
headlines were dollar up, dollar. The dollar weakens again. And the market doesn't do it. The market and energy
right,
rallies
right. Yeah.
30 cents, 40 cents. I mean, come on.
So we met. Our last podcast was 2 months ago, and you thought the EIA, the IEA were wildly overestimating demand going forward, and they did revise demand numbers last month, and so you had a good this month's EIA is out. What do you think of where they are stand now for energy demand?
Oh, I think they're continuing to be too high. You look at the EIA. Well, the IEA and OPEC haven't come out yet.
Right, for this month.
So we'll see. The last ones I thought were millions of barrels a day too high on the demand. The EIA, which has come out, I think is also probably close to 1 million barrels a day too high. U.S. demand alone, they're looking for a big pickup, Jim. If we look at the fourth quarter,
Mm-hmm.
they're looking at a mammoth increase of 700,000 or 800,000 barrels a day just from August into the fourth quarter, and they're thinking that the big increase. They have jet fuel going up, and they have NGLs going up 500,000 barrels a day. I don't know about that. I think that's wildly optimistic. We certainly could grow in the fourth quarter, but I don't think by anything close to that. And I don't see, again, jet fuel's a big problem. They have gasoline steady to a little higher, and they have diesel a bit higher, and that I could buy all that. But on jet and NGLs, I don't see it. I don't see those big numbers.
Yeah, I mean, if you look at their macro forecasts, which they get from an outside source, they were looking at a minus 4.8 GDP in 2020 for this month's forecast versus minus 6.1 for their August report. So that's a huge change in GDP. It's just kind of like we're so used to seeing these huge economic numbers now that it doesn't look like much. But I guess I'm showing sympathy for the EIA trying to get a handle on this stuff. Would you say that's
Yeah, I have sympathy for anyone trying, including myself, trying to get a handle on this. I think they use a model. Sometimes I think you have to use the facts on the ground too,
right?
as to
Right.
and maybe overrule your model. I don't know if the government does that or not. I mean, Jim, you work for the government. When you
Yeah, there was.
in your early days, when you saw something that you thought was just not right.
Yeah, there's with a committee. We had major input into the numbers that were sort of discretionary. I mean, you added your analysis outside the model. Yeah, definitely.
Yeah,
definitely. But I guess your question to them would be, how are we going to get there, right? I mean,
yeah, how are we going to get there?
When you say numbers on the ground, you're saying here's where we are right now. We need a lot to happen from now
right.
to
Here's where the demand is right now. These are the jet fuel miles traveled. How are we growing?
Right.
To what you say, and on the NGLs, where's that coming from? Is that ethane? Is ethane going to go, going to go crazy from now till the end of the year? I don't see it, but it's possible. I guess. I mean, the EIA is putting it out that way.
I think you need to go see the movie The Graduate, and then you might be a little more optimistic.
Exactly. Exactly.
The word is plastic, Sandy. Plastic.
Right. For those of you who have not, for the few that have not seen one of the great movies of all times,
Yeah.
yeah, the word was plastics, which is, well, you mentioned, Jim, when we had a pregame talk, you did mention that packaging is growing, certainly. And
Yeah. I have to say, in our house, we have used Amazon a lot, and then Amazon boxes come with packaging, and it seems like there's some, petroleum products inside keeping stuff from breaking. So.
yeah, that's definitely the case, and that alludes back to the point I was making on demand for goods. Is that going to continue? We'll see.
So why don't we sort of get closer to price forecasts going forward? We've had a, I think I think we've seen a low already, if you want to count that minus number we had, but we have bounced off of that, got into the low to mid 40s, and now we're back below 40. I'm talking WTI. What do you think? How are we going to go out through the rest of the year? Is it going to be more choppiness sideways, or?
Yeah, I think choppy sideways is a good way to put it. In our last monthly, I think I was talking about like 38 to 42, maybe a little bit higher. I think we are going to be range bound here. It is going to be. We'll look and we'll see if there are clearly a lot of unknowns in our market,
A lot of
both on
unknown
both
unknowns.
unknowns, right?
Yeah.
I mean, both the supply and demand side. I mean, certainly if Libya out of nowhere came, we've seen that headline that they've reached the truce. Certainly if they came back and added 500,000 to 1,000,000 barrels a day, that would be bad. That would be
Yeah.
bearish,
Right.
clearly. If China, if the market comes off and then we get a bid off China, maybe the market holds and starts coming back on the upside. OPEC cuts production. Again, that could be supportive. These demand numbers come in higher than what I'm thinking. That certainly could be supportive. I do think that. I mean, Jim, you made a good point on China, and I'm pretty certain that should the market get into the lower 30s, there'll be buyers. With Brent in the mid 30s, I think there'll be buyers.
So,
And Jim,
yes.
and we have the election ahead.
I was just going to say, do you see any volatility in the marketplace from the election? And I mean, I'm not sure I would put a vol play on for the election, but some people are I mean, I think it's in the VIX. I think they've been talking about it for a while, where I think it's the month after the election is a higher VIX than the month before it, something like that. I don't see. Do you see anything like that happening in the oil?
For oil based on our fundamentals,
Yeah,
not really,
not really.
because we're still oversupplied. Yeah, there could be. I should say not really. There could be. I think for our next for our October podcast, maybe we'll talk a little bit more about the election and
Yeah,
talk about where we see the Biden policies relative to Trump's, and if there's any play there.
and also I think that how the Senate turns out is probably more important than the president, because if
Totally.
you get Trump with a Democratic Congress, or you get Biden with a Republican Senate, probably not a lot changes from where we are.
The other one last point, and it's an important one, because the one thing that we are seeing is that the refinery margins continue to be really poor, and that's clearly a function of the demand side, but it's also a function of the overcapacity on the downstream. And I think that one thing that will be healthy for the market is going to be some rationalization of refinery capacity. We really need to lose refineries in Western Europe and in the U.S. And it's beginning to happen. Some are being repurposed to make renewables rather than refined products. So I think that's certainly a very, very good trend. Not so much maybe for the owners of those refineries, but it has to happen.
Right.
And that's something that we'll continue to watch. And I would say that watching these refinery margins will give us a good clue of where the market is going, because a healthier refining margin means that demand is beginning to pick up in a good way, and that may spark a longer lasting recovery.
I guess the question is, is it a business that you want to be in? I mean, obviously, oil companies are in it already, but if it's do you want to be the last buggy whip sales or manufacturer? Does it make sense for, I guess you're seeing a lot of oil companies trying to redefine themselves in the area of clean tech, clean energy, things like that. Just running around. How's it going to unfold? So does it unfold with like the last refineries are making huge margins, or are they just lumbering along and not doing well, but still hanging on for dear life? I guess, the last cigarette companies apparently done really well.
Right.
But will oil companies go that way? I don't know. This is something I'm working through. Are the electrical vehicles? Are they going to reach a tipping point where? And when does that happen? Is it going to be faster than we think or slower than we think? I just don't. These are things that you kind of we talk about.
We do talk about that. I think you have to have an eye on the future. I mean, these Western European oil companies, the majors, they are making some big investments.
Yes.
In clean energy, and why not expand your portfolio when you have the capital?
Yeah, and the car companies are doing electric vehicles. They just don't seem to be. It doesn't seem to be showing up in their valuations like a Tesla. I mean, Tesla's more than a car company. I understand that, but you're getting like Volkswagen and others that are doing interesting things with electric vehicles, and yet they don't have the valuations, I guess. Anyway, this is an area that I know little about, so let's talk about options. No. So we talked about gasoline. The ARB is open from Europe. I think that's what you're indicating.
The ARB is, I think that's gasoline in Europe is again, that is they're oversupplied as usual for Europe. That's just structural, and it's going to be difficult. Any rally, Jim, in Pad 1 in New York is going to get hit by European imports, and we'll probably start seeing everything moving west from China, from Asia into Europe, from Russia into Europe, and Europe into the U.S. Again, it's the story of the market. We're still oversupplied. So let's not forget that we built between 800 and 1 billion barrels during the first half of this year.
Right.
We've got to work those off, and it's gonna take time.
I think that's a great place to end this, Andy, because we hear people looking for amazingly high-priced oil going forward because of the lack of investment in, new supplies. And it's even if that's correct, it's not a straight line.
Yeah, it's not a straight line.
Yeah,
And right now we're a squiggly side, we're a squiggly line at lower prices.
right. Anything else you want to add before we say goodbye?
Well, Commodity Research Group can be found on our website, as you mentioned at the beginning, commodityresearchgroup.com. I could be reached at Lebow at commodityresearchgroup.com. Feel free to drop us an email with any questions, or if you have interest in seeing our monthly reports or anything else, let us know.
Terrific. Thank you very much, Andy. I'll be talking to you next month and probably later today too.
Okay, thanks, Jim.